Hello, everyone. Welcome back to another episode of Let's Talk Housing. My name is Brennan Thomas, an economist, and I am the co host alongside Stephen Thomas, the chief economist and founder of Reports on Housing. Today, will discuss the most recent economic news and statistics, the government reopening, which happened very, very recently, and that makes us happy, mortgage rates, a quick NAR forecast, economic bubble concerns, and more. But first, Stephen, what is going on in your neck of the woods?
Well, we're down to just cross country. I think we talked about that last time, but we have CIF finals tomorrow morning, bright and early for us. We're recording this on a Friday evening, and it's like the very early. We've got to be up like up in Los Angeles for this. It's at Mount Sac. And we're going to do the rain course because it's been raining like crazy here in SoCal. And it's one of the hilliest, muddiest courses, but it's rained so much that they will run a flat rain course instead. It's like the exact opposite of what they're known for. But after this, their team is so good, their cross country team, that they were going to qualify for state. Then the day after Thanksgiving, we're going to climb into a car and drive up to Fresno, and that is where there's a park there that they have it every year, the state in cross country championship, and so we'll be there. That's where we're going to go. That will be on. So we climb the car Friday after Thanksgiving. On Saturday morning is the actual race. So, and we make a little weekend out of it, stay in a little Airbnb, have a little bit of fun, that type of thing. So that's what's going on. That's really what's going on. And of course, Zeke had a basketball game today, and we just realized he's in the second grade, and they moved the hoops from 8 feet to 10 feet. And oh my gosh, it was so hard to watch. But some of these kids are so incredibly good. It's like, holy cow, I don't even know where these kids get these kind of skills. But we will struggle together, because I know very little about basketball, and Zeke loves the game. So we're going to be playing lots of basketball. But first thing we're going to do is raise our hoop in our own yard. So that's what's going on over here. As I just keep on, I can talk about the kids and the family all day long. We're going to have a great Thanksgiving celebration, that's for sure, next week. But and our Ducks, we are Ducks fans, and we've been watching lots of Ducks, and they've been playing pretty good. But lately, the training wheels are a little wobbly because they're a young team. So we need to tighten those training wheels and score a few more W's. Anyways, that's what's going on. How about you, Brennan? What's going on in your neck of the woods?
Yeah, just enjoying the rain, the weather. It feels like I'm back in Washington like I was a couple of years ago, but it's been enjoyable. Running's been great. Sports have been great. I told you before we hopped on this, I'm not going to say too much. Don't want to jinx anything, but
We won't talk about Arsenal.
I'm going to bite my tongue till the end of the season, which is May. So I got a couple more months. But whatever, that's fine. Going to the game tomorrow, which is super exciting, and which will be past tense on Saturday when this recording is up. But I am just so excited. I am loving the Ducks. It is so exhilarating. Even when we lose, even when we win, it's just like fast-paced, fun hockey, and I haven't seen that in quite some time. So it's electric. Electric. That's how I describe it. But what's been going on with real estate? I know it's the transition to the holiday market. We got Thanksgiving coming up in a week, just like you said. What is happening with supply demand in our very unexpected market time?
So what we saw is a giant drop in supply and a giant drop in demand this week. We can see it in the numbers across the board. Then what happens is from here is we actually see something a little bit different going forward. But that's what we've just experienced. This is officially the holidays as of Monday, the week before Thanksgiving. Because now we're at the weekend before Thanksgiving, and now that you're at the weekend, people are coming back from college, people are doing all different things, they're moving all over the place, there's lots of travel going on, and everybody kind of like places everything on pause. And that's why you see this big drop in inventory and drop in demand. Now, for the next report, what we'll see is a big drop in inventory, but not as big of a drop in demand. And the market will actually speed up that first week of December, and people will go, "What's going on? How come it's speeding up, and that's because inventory will drop faster. Fewest number of homes come on the market in December, second fewest in November, and we're at that point where you're just not going to get that many people that are coming on the market. And anybody that has been languishing on the market, they're throwing in the towel. They're throwing the white flag and saying, "That's it, I'm done," and they're delisting. That's the new term. It's delisting. They've decided no longer to be listed. They've delisted, and there's fewer homes coming on the market. The combination of the two make inventories drop fast and rapidly. And so, but during this week, right before Thanksgiving, we see a big drop in both demand and inventory. It's pretty sizable. So that's where things are kind of going. So the overall speed of the market doesn't change much, and that just surprises people. Used to be, prior to the pandemic, that during December, the demand would come down faster than supply, and the market would slow a bit during the month of December. But it's been the opposite recently, and especially this year with rates below 6.5%, which are a good percent better than where they were like last year at this time. So what happens is now you're getting demand that won't come down as fast as supply, and the market will actually do the opposite. It won't cool down. It'll actually heat up a little bit, and that's kind of what we anticipate to close out this year. So that's kind of where things are at right now.
Got to close out this wonky year. It's been a little bit interesting with mortgage rates dropping and everything, but certainly all we can say is it has not been normal, at least like it used to be in before COVID. But now that the government has reopened, thank goodness, what has changed over the last week or so, and how will that impact the future with economic reports? What has been released since it's reopened? What is making you happy as of November 21st, which is today?
Yeah, I'm just excited that we finally turned the spigot back on, but the spigot causes a logjam, and the there's when there is that blankness of nobody working. There are many reports that require people to do various things and do surveys and do check prices and do different things along those lines, and it will be a hole in the data for October. Now, September, they closed things down on October 1st. On October 2nd, we were supposed to get a jobs report. They released that yesterday, and it came in a lot higher than expected. But they haven't cleaned up anything, and they haven't looked to see if they were incorrect or anything. They haven't had time to do any of that. So this is like as if they had just released the report on October 2nd is what they just released. No fixing it or anything like that. And that's been the nature of these reports, is that they've been so wonky because there are a lot of the surveys haven't come in. They haven't had the ability to go through it and see how many additional ones they have and start to fix those prior months. This one looks broken because we've got a lot of private data for the month of October, and it actually appears to be negative for the month. So for this one to be a big beat made no sense. But at the same time, we had unemployment rise to a level where it's now flashing yellow for the Federal Reserve, which is why, even though we had that really high report, nobody kind of believes it in all the investors. And then on the flip side of that, unemployment went up. They believe that. So we actually had rates come down a little bit yesterday and today, a little bit of a fall through, not giant, just like tiny bit, but if this was a normal report that you could actually say, yeah, it's not going to be revised, it's 121, a lot higher than expectations, you would have saw interest rates rise, but that's not what we saw. And then people are saying that's so old. That was for the month of September. We are getting towards the end of November, and we're just now reporting September. This should have come out on October 2nd. So like I said, getting this thing so old and dated, it really is not moving the market. And what they just announced also is they're not going to be releasing October. And then they won't release November until the middle of December after the Fed meets. So the Fed will have very little guidance. They'll have some. They have some private reports. They have the same things that we were looking at that shows that there's real choppiness, shakiness, and further weakness in the labor market. And when that happens, it means that they're still a little bit too restrictive. So there's this big debate on whether they're going to go or whether they're not. And after the report, the initial thing was they're not going to go. And now one of the Fed presidents came out today and said, yeah, I think that we should do a rate cut. And that's what made the rates come down a little bit more today, and bond market came down as well as rates, because they really should go. They should be in front of this. If they wait for further data, because we're not going to get really good solid data until after they meet, and then it's still going to be wonky because this tap was just turned on, and it's like the pipes are frozen and they don't have all the material that they need, and they don't have enough days in the of November left to accurately put things together. That won't be until January that we start to see a real idea of where things are at as far as the labor market's concerned. We do have initial unemployment claims, and they've been coming in stronger than a little bit stronger than anticipated, which means that the labor market hasn't broken. So we know that labor market hasn't broken, but we also know that it's the 16 to 24-year-olds that are having the biggest problem. Those that don't have college educations are having it, and younger are really having an issue with unemployment. So there's these different facets of the economy that are really struggling, and you're starting to see that there's some weaknesses that are appearing. They're starting to flash a little bit within the economy.
Oh no, some of the doomers may say.
And so, by the way, we're not going to get a CPI report also for the month of October. So it's a big, glaring, giant, gaping hole. And we're going to get more data coming forward. We just don't know exactly what pace it's going to be at. We just found out that the jobs is later after the Fed meets. So they're still ironing out when they're going to be able to patchwork put things together. And that's just it. It'll be patchwork. So it's like I said, we have to get beyond this, and it's beyond December into January for them to be open long enough to start giving us some real good, accurate information.
Now, I want to transition back over to mortgage rates. So obviously the government reopening and all the reports coming back out. Now mortgage rates have something to react to, but now we're not going to have as many reports. Like you said, the October report's not going to come out. So our 5% mortgage rates, the lowest we'll see going forward. I know before COVID, we used to see mortgage rates a lot lower than they are today. I can tell you that much, but are the days of 3 and 4% mortgage rates, are they gone? Is that something that can come back way down the line, or are 5% rates just sort of the baseline for maybe on the lower threshold?
Yeah. One of the things is the spread. The spread's been getting better over time. It's a lot better. Today's interest rates are like about 6.35%. They would be above 6.5% right now if we had last year's spread. And just know that for everybody out there, that interest rates got artificially extremely high. They could have been lower, but they were a lot higher because there's a lot more risk after the rates went up like crazy. And the risk is that rates come down, and everybody that is tied to the loan that they purchased the rights to, or they're servicing the loan, that all of a sudden they refinance, they lose. So loans actually have to be held for 2 years for them to make a profit. So when people refinance so quickly, they lose a lot of money, and that is the risk that they have to take. So there's these extra high mortgage rates to cover that risk. And because we thought back in 2023, a lot of people thought that we were going to get back into the fives, and people were saying date the rate, marry the house. That turned out to be a total joke because we've been stuck in the same area for close to 2.5 years now. And now that we're finally down towards 6%, the reason for that is because rates never really adjusted down like everybody thought. So where we're at today at that, like about 6.35%, if the spread was back to normal, where it's been the average since 1971, which is actually for the Freddie Mac mortgage market survey, they do a survey of interest rates. The spread is 1.76 above the 10-year Treasury. It's a lot higher than that right now. It's not that high like it was last year or the year before in 2023. It was awful because we even had 8% interest rates. Right now, if we had the spread of 2 years ago, we'd have interest rates above 7. So the spread's been getting better. We're at 6.3%, and the spread could get even better and go back to that 1.76, and we have interest rates already in the upper 5s. And that's before the economy actually cracks. If the economy down the road were to crack and labor were to crack, they would go all in, and all of a sudden they'd want to get to the neutral rate. And they would actually say that they need to be respond to the labor market, and they'll talk more about the different things they could do in their tool chest. And you could watch rates come down as a result of that. That would get us into the. I could see it plausibly getting into the fives, even lower fives band. Now, can you imagine if we went into a recession? So I've talked about some breakage. If we actually went into a recession, that's where the federal funds rate even comes down further. You can see a further adjustment and get into the fours. That's about as much as I see is hanging out in the upper fours. Down the road, if we had a recession, which nobody's calling a recession right now, except for some doomers and some other people that are they're elevating their voices a little bit. And then you heard your brother tell you in the spa about something that's going to break, because that's what it is. And he's a fireman, by the way. So yeah, he definitely knows the economy because that's what he follows. But these are, after you hear enough people out there and people have these different takes, you start to wonder, okay, what's real and what's not. So we don't foresee one right now. We'd let people know if it was in the cards and we were seeing some further flags, but there's just some cautionary flags right now of a slowdown, and that's all that we're seeing right now. But those are the pathways to lower rates. Getting into the threes, I used to tell people, yeah, we'll never get into threes again. Then we had a pandemic. So then we even got into the twos. So there you go. I can't say that we'll never, ever get into threes again. I can't foretell the future as to future pandemics or future other what they call exogenous shocks. And that's where there's an outside force that all of a sudden comes in that nobody really planned for. And that could disrupt mortgage rates and bring them down further. Outside of any kind of major exogenous shocks, that's pretty much what it is. Fives for right now, upper fives, and then get down lower if things were to break, and then get into recession, you could see it even go lower. It's like we'll have to wait and see down the road as to what those economic data points are. But for right now, we don't foresee anything like that. We could see getting in the upper fives. That's about it.
Well, that will be better than what we have today, and I'm sure the market will react to that. But NAR is forecasting double-digit growth in home sales for 2026. Do you have a similar forecast for this upcoming and exciting year, which will be 2026?
And not as high as that, but we can get high like that. And that is if the labor, and that's not even the NAR's take isn't for interest rates to get into the fives. So I don't understand the pathway to it yet. So it's like, okay, I'd rather be wrong and we do more transactions, but I can make a case for getting as high as up to 10% more activity. But we have to have the labor market break, and then we get below 6. And now you're making your way towards the upper fives, like 5.75%. And that's what we say anywhere from 5.75 to 6.75 next year, but our base case is 6 to 6.5. And but that 5.75% can happen if the labor market breaks, and that would be the pathway. The lower rates would open up a giant band of activity. I personally don't pray for that rate, and it goes against what a lot of people think, and that's because I really care about millennials and Gen Zs, because I have a lot of them as kids, and then I even have an alpha. So I care about future generations, and I just don't want to see rapidly rising prices in the entry level price ranges for in the various markets. And that's what would happen if we got into the fives. There would be a lot of infighting between millennials and Gen Zs for a depleting number of homes in the entry level ranges. So when they do that, prices go up too fast. And that's not what I want from millennials and Gen Zs who have been waiting on the sideline, waiting for rates to come down. I want to do it in baby steps, 6% first, and then maybe the second half of the year we can get into the fives. That's kind of what I am personally getting down on my knees for every Sunday.
Well, you're saying you're not sure where the demand will at least come from, but one way that it can come from is a bunch of talk that's been going around about housing. They've talked about the 50-year mortgage. We brought that up. You did a video on that, but somehow portable mortgages are being brought up again. So what are the pros and cons of portable mortgages? We talked about it a while ago. I remember, I think it was about a year and a half ago, but what are the implications of it actually happening as it's been brought up again?
Yeah, the more research that you do, the less of a possibility that's even going to happen. Really, at the end of the day, there are a lot of investors that purchased the way that these notes are even put together. There's no portability. No portability. You can't move it from one place to another, and there are people that buy notes and they buy mortgage-backed securities, and in that they know that there's a certain churn. This would change that dynamic completely, so that the investment and the risk and everything else on it would be calculated differently. So you're all of a sudden changing the instruments of what investors have already purchased. To do that would invite litigation. So I just don't see a pathway for that happening. I could see a pathway for that happening going forward and saying, okay, yes, these are portable mortgages, and they're written that way going forward, and that's what the investors purchase. But that might be a little bit of a different risk. There might be a different pricing on that. We might see different rates on those. So it'll be interesting to see how that works out. But I just don't. The more that I look into it, the more that it does not seem plausible. So I don't think that it's going to happen. It would end up in court, and there'd be too many issues. But I applaud anybody for thinking outside of the box a little bit, and how can we increase the increased movement in the United States, and working on the demand side of things. Interest rates will fix that. Working on the supply side of things is exactly what we need to be looking at. This is one way of looking at it. It's not going to really work in the end of the day, is what we think. But I could see other ways of adding to supply. One of those would be, especially in high cost markets, we need more supply so that it's not a supply constrained. And one of the ways of doing that is to actually unlock the capital gains exclusion from 1997 dollars, which is at $500,000 of an exclusion of capital gains for couples, and $250,000 for individuals. So, for people to understand that is, if you bought your house 35 years ago and it was worth, let's say, this is just hypothetical to make it easier math, it was worth 500,000 and now it's worth $1 million. That's a $500,000 gain. You can actually, real simple, that's a $500,000 gain. That is tax exempt if you're married. So even though you sold it at $1 million and you bought it for 500,000, that extra gain of 500,000 you won't be taxed on. But there's other things that go into it, like different property improvements and things like that. But let's say you bought these. A lot of these people have been in their houses for so long, it went from $30,000 up to $1 million house, like in California, let's say. A lot of older people don't want to move because it's now a giant capital gains hit. Let's say they have $100,000 improvements and everything else. They went for $1 million. That's $900,000 gain. Now they're taxed on not all 900. You subtract 500 if they're married, and it's 400,000 that they're taxed on. They don't want to be taxed on that, so they're not moving. So what they need to do is take that 500,000, which is what it was for a couple back in 1997 dollars, and that was like a McMansion of a house at $500,000 back then. 500,000, and take that 500,000 and move it to $1 million. Take the $250,000 for a single and move it to 500,000, and that will help in the mobility for a lot of people in the higher cost states, and allow us to add more sellers to the equation. And that's really what it is. Enable them to finally do things. And you're penalizing some of these people, and they're just staying put. It's adding to the age in place that's already taken place with anybody that has silver hair. They're just staying put, and because of the capital gains being where it's at, it's making it even more of a dire problem. So they can do a bit of a fix by actually fixing this right now. And I know people that would actually sell if this thing was fixed tomorrow. And they've been talking about this for Congress for years, and they keep on kicking this down further and further and further. What they don't understand is it creates more movement, which creates more transactions, and at the end of the day, creates more dollars for the economy, not just in commissions and the people that are tied to it, but when people sell their houses and people move in, it just adds to the economy. It adds to Home Depot and Lowe's and trades and different things when they're fixing things up. So they got to look at it that way.
All right. Well, thank you everyone again for tuning in to another episode of Let's Talk Housing. Happy Thanksgiving. We are so thankful for you. If you want to learn more about what's going on in the real estate industry across Southern California, Bay Area, Phoenix, Las Vegas, or if you have places where we should expand to, reach out, let us know, and we'll make a note of that. But please leave us a good review. And if you have any questions, you can send it our way. But we'll see you very soon, and have a fantastic and wonderful holiday. Thank you.
Thank you. Happy Thanksgiving.